Economic data is probably the least useful stuff. You're trying to build a puzzle, only put one piece in, it's hard to get the picture. If you put multiple different pieces in, then you kind of start to get the picture. So you've got to find your balance between how much do I want to chase opportunities, how much do I want to try and get rich versus what am I still going to focus on that's boring and uninteresting and defensive. The investment opportunities, they're like buses, they come over and over again. And just like the cycles are seasons. They're probably at the top of that cycle around the trend at the moment.
Welcome to another weekly episode of The Trading Battle. I'm your host, Steve Ruffley. Today's guest is Callum Thomas, the founder of TopDown Charts. Callum is widely recognised one of the best when it comes to innovative and insightful charts on all things macro and the markets. His chart-driven analysis and concise commentary has helped to track a low following of institutional and individual investors. They value his unique and independent perspective, and since starting TopDown Charts in 2016, he has become a trusted source for some of the world's largest and most influential investors. Aside from his work at TopDown Charts, Callum is also known for his weekly chart storm, which is a collection of some thoughts on the most important charts and issues in the US stock market. Callum, welcome to the show. How are you doing?
Yeah, thanks for having me.
No, anytime. It's our pleasure. So, got to start as always. Tell us where did you start, mate, your journey? How did you get involved in the finance world? Starting TopDown Charts, what's your story?
Well, it depends how far back you want to go, I suppose. I mean, if you want to go all the way back, it probably started from selling pine cones as a kid. You know, catching the money bug, and then from there, kind of like looking in the newspaper and seeing, what's the stock market page? This seems to be kind of interesting, like for no real reason. Like there's just a little thing in my head saying, something about this is interesting, because back in the day when you had the newspaper and the stock market page. And then that kind of led to I had an older cousin who was quite involved in the stock market, and he sort of given me this sort of rundown of this is what it's about, gave me a book to read, which of course I read cover to cover, bought my first stock, and then from there it was kind of destined, right? And then I was going down a road of, maybe I can be a scientist, but then I sort of thought, well, what if I go and do this as a career? And then, so long story short, got my first job at AXA Global Investors. No, sorry, the first job was at NZX. The first investing job was at AXA. So at NZX, that was in the New Zealand Stock Exchange. So part of the company that actually manages the exchange, but they had quite a few other things going on. So sort of managed to, poke my finger into a few different things, from M&A through to corporate strategy, pricing, and then a bit of stuff on, they had a fund manager research business. And so, that kind of solidified to me, this is actually the kind of stuff that I want to do. And then after that, joined AXA Global Investors and the investment team there. And so that was really like foundational experience, because being in New Zealand, it's very small teams, so you're required to do a lot of things, but you're directly exposed to the whole spectrum of things from, research and portfolio management, implementation, liquidity management, product marketing and all that kind of stuff. And then, through, it was kind of another round of iterations of let's try a few, like get exposed to a few different things, try a few different things and be like, oh, well, actually the thing that I like the most is the research and strategy, and then specifically for that, dynamic asset allocation. So this team was in charge of managing, your multi-asset portfolios, so your retirement balanced funds, etc. And so there's really two key questions to answer from a strategy standpoint. One is what should the ideal mix of assets look like for a strategic, long term? What should the sort of default allocations be? And the one that everybody's probably aware of is the old 60-40, so 60% in stocks, 40% in bonds. Of course, things have evolved a lot since the days of 60-40. It's now, okay, 60 is, it's a split between domestic stocks, global stocks, commodities, REITs, things of this nature. And then on the 40 side, it's not just bonds, it's bonds, cash, domestic bonds, global bonds, and, gold or other defensives. And so okay, what should the sort of default be? But then also, because all the numbers and inputs that you base that decision on, they're a moving target. And so, you set a strategic allocation, but then the very next month, things might have changed significantly. And so you have this thing called tactical asset allocation or dynamic asset allocation, where you're making tilts around that benchmark. And so, from a really basic or conservative standpoint, it might be saying, well, actually things have gotten riskier on this side, so we need to make an adjustment to kind of pull back your exposure to risk. Or on the other hand, it might be like, well, actually we're trying to get our clients good absolute returns, so we want to reflect that we've actually come across some good opportunities here, so we're going to be more aggressive into equities, or we're going to introduce exposure to a certain country or region that we believe is going to boost returns. And so, I think it's probably obvious to anyone who's listening that that's kind of the more interesting part of portfolio management. Well, some might say that the portfolio management side is because you're the one who's making the decisions and making all the calls. But I found myself gravitating more towards the research side of things, because it's sort of like it's the intersection of, and I think you're quite lucky if you can actually discover this sort of intersection between something that you really enjoy but also have a talent for, and then you build your experience, and if it's something that's actually valuable, which that happens to be, then the opportunities kind of will sooner or later they're going to reveal themselves too. And then that was the start of TopDown. That's kind of ultimately what led to the start of TopDown.
Oh yeah. So you founded it because not only did you see a niche in the market, but that's really what your passion was.
Yeah, exactly. And then of course I had a few of the portfolio managers at work had kind of mentioned to me from time to time, oh, what you're doing is pretty good, because I was sending out some internal publications as well, and they were saying, what you're doing is pretty good, you should think about starting your own thing. And I'd done a few sort of entrepreneurial things before, and I was like, oh yeah, actually it's a good idea. Yeah. And how it ultimately actually happened was we went away on holiday to Bali, Indonesia, and family holiday, and of course when you get into very different space, it gets you into a different mind space, lets you actually stop and sort of think about things. And I was like sort of writing some notes down, and then took the wife down to the beach, and we had those cocktails, and said, oh, what do you think if we do this? She said, yeah, let's do it. And as you do, you go back from holiday and take your boss aside and say, yep, I'm done. And that was all the way back in 2016. Managed to so far at least stand the test of time.
Absolutely. I mean, there's a lot of kind of things I guess to unpack there. So as we spoke off camera, when you are just analysis driven, you've got to stay very much independent from the noise. So I guess what's really interesting now is what's your take on everything? So obviously, charts are charts. Let's start with the charts, the technicals. The way I used to look at it, trading was maybe 80% charting, 20% fundamentals. As a trader, a day trader, that's what I looked at. Now I think it's more 50-50. So if we just go back to the technicals, now obviously you provide charts and you've done your own indicators. What do you look for, and how do you put those charts together? And I guess what I'm trying to get from this is for people that haven't been doing this that long, how's it changed and where's it going?
The way I look at things, like if I want to explain the process of how do I come up with an idea. In terms of my day-to-day work, I provide a few different things, but one of the things that probably is most tangible or most understood is providing investment ideas. And so the process I have is basically to bring in what I call 5 different categories of information. So one is valuations, and that's really about having some kind of objective anchor indicator that will really ultimately move through the cycle. And so at the start or the bottom of the market cycle, when things are everything's bad and it's things are cheap, the indicator, that a good valuation indicator should say this thing's cheap. And then at the other end of the cycle, when things are overheated, expensive, and topping, that's when the indicator should say expensive. And so first, kind of stepping into indicator design here, but from the valuation standpoint, starting with that, having that as a kind of key guiding thing can be very useful because it sort of helps set your directional bias and tells you about the inherent risk backdrop as well. So like, and risk can in that situation be understood from two perspectives. So at the other end of the cycle, the topping end of the cycle, risk is, when valuations are at levels where things have peaked in the past. So for example, standard deviation expensive. That tells you the inherent risk backdrop is quite risky for long positions, because the risk is that you have a sudden turn that you're unable to react to ahead of time. And everybody thinks, oh, well, yeah, I don't really care about expensive valuations because I'll get out before, I'll gracefully exit before the thing turns. Doesn't always work that way. But it tells you about the inherent risk backdrop. And then at the start of the cycle, when things are cheap, we can actually still think about it in terms of risk, because risk there is not having a long position, or, if you're short, that it turns and leaves you behind. And so that valuation's a great starting point for it. But then, anyone who's kind of spent any time looking at valuations, or even just from that, you probably understood that you can't just look at valuations. You've got to look at other stuff, because, well, when you're at the start of the cycle, valuations are cheap, getting cheaper, getting more cheap. That's called the value trap, or that gets cheap, stays cheap, and never recovers. And so, you need things to keep you out of trouble. Basically, which technicals go a long way to doing that. And so, and I actually call technicals, they're kind of like at the other end. So I call that, valuations number 1, technicals are number 5. The technicals can get you out of a lot of trouble in that kind of situation. Like if you identified something is cheap, and, looks great from a valuation standpoint, you still want to see the technicals turn. Like ideally you want it, the price to stop going down, right? If you're trying to identify a trading point or call a bottom, well, rule number 1 is the thing has to stop going down. And so, there's a range of different things there. Like it starts making higher lows and higher highs. So, the classic definition of a trend turning, or just simple moving average crossovers. You can save yourself a lot of heartache, but just paying attention to the 200-day average. That's the old saying that nothing good happens below the 200, and statistically that's pretty on the money. But to go back, the second kind of category of information would be cycle related stuff, and so that's where some of the macro stuff would come into play. And so for the stock market, it would be obviously things like earnings cycle, economic indicators, and so if you're thinking about the bottom end of the cycle, you'd be looking for things like the economic data to actually get so bad that it's good. So, if things are so bad that it's good, it means 1, they can hardly get much worse, and 2, they trigger policymakers into actually doing stuff. And so that leads you also into category number 3, which is your monetary financial conditions. And so that, and certainly that was like a massive factor coming out of March 2020. The valuations lit up as cheap. You had the technicals say oversold, but that monetary factor was just critically important there. And then also at the other end of things too, like when the stock market's expensive, and you're technically still in an uptrend, it's the time isn't really called on it until the monetary stuff starts tightening, or the macro stuff gets too overheated, turns the corner. And then the fourth factor, for people who are keeping count, I call that basically a mix of sentiment, flows, positioning, kind of tactical stuff. So if you think of the first 3 things, valuations, cycle, monetary, these are kind of more fundamental things, slower moving things. Sentiment, flows, positioning, technicals, these are your generally faster moving things, and generally more sort of tactically relevant. So you might come up with a good sound thesis of it's cheap, the cycle's turning, it's looking great, monetary's playing ball, but you still need those technical elements to say, yeah, and now's the time to act, and also, or now we've got confirmation, so rather than having a low conviction view, we've now got a high conviction view, and so to me, it's you can kind of sum it all up as saying that you're trying to build a puzzle, and if you only put one piece in, it's hard to get the picture. If you put multiple different pieces in, then you kind of start to get the picture. But if you put too many pieces in, you've got every single piece. It's obvious. It's obvious to you. It's obvious to everyone else. Probably you've got too much information, so you kind of got to find that little sweet spot of information. And from a research provider standpoint too, I think of sort of a quadrant of conviction level and consensus level. So, the things where people value you the most are when you've got high conviction and it's not in consensus yet, versus, if you don't have much conviction in it and everybody else is saying the same thing, then probably not very useful.
Yeah, I mean that's really interesting. So yeah, you combined everything into the 5 factors. So are they kind of equal weight, or does that kind of change through economic cycles? Do you factor that in?
Yeah, great question. Because when valuation signals neutral, useless, no information. When valuation signals at an extreme, like the most extreme it's ever been, it might take all the weight at that point. And I mean, I probably should think about, putting quantitative things around it and rules. But I think by now I've kind of learned that, especially with asset allocation, I think that there is still a human element to play, because, you could probably get most of the way there by making just an algorithm, like some grand theory of everything, and have all these different formulas and inputs. But I think having the judgment factor is still important, because even though things can rhyme, things get different, and and you learn stuff across the way as well. Like, there might be some specific example or some scenario that hasn't happened before that your algorithms will fail on, because you never foresaw that as the person designing the algorithms in the first place. The way I kind of incorporate those is, well, first of all, by just having, focus on charts and data as the foundation. And so part of that is indicator design, which I kind of touched on before, which, the indicator has to do what it's supposed to do. Ideally does that reliably, consistently across time. But then, once you have all these sort of quantitative inputs, you're very chart driven, data driven, and you can actually put these into like a little grid. And so, and you can give them, like what I specifically do on a monthly basis is give them a, green, yellow, red, traffic lights. And if they're all green, then the overall score is going to be green. If they're all red, the overall score is going to be red, and that kind of helps guide you to where the positions should be.
Yeah, I mean, that totally makes sense. I mean, from the technical side, it's very attractive, isn't it? I guess, obviously the way your brain thinks and, what you're interested in, numbers, maths, outcomes based on probability. I think what I'm experiencing is a much shorter term trader is, how do you look at the future, especially things like the fundamentals, as I've said. We've got some key issues around data. I've been writing a couple of times that, the data, like the non-farm payrolls, didn't kind of make sense. Then we get those huge revisions, and then Trump says, well, I might just stop releasing the data altogether. I mean, I'll just fly an interesting question from your standpoint. This will probably make your head explode, but if we had no economic data, how would you judge anything?
I think it'd be great, because, I mean, economic data is probably the least useful stuff that you look at anyway. So, okay, there's a little bit of nuance there though too, because like, if you look at the stock market and you look at, what makes a bear market, your traditional garden variety bear market, it's when the economy's in recession, in which it comes back to earnings. And so, I mean, well, just to kind of get a bit sneaky there, if you deleted all the economic data, you'd still have earnings data, maybe.
Yep. Yep.
Which, and actually, and I've dealt with this actually quite a lot with, I China's one market I've been following very closely over the years. And
Sure.
I think with every country, there's always going to be an element of like, do we trust the data as such? And you might technically trust the data, but you don't necessarily trust what it's telling you until you've verified it with other stuff, which you can do, or verify what it's telling you from a signal standpoint by saying, okay, well, sure, but what's going on with earnings, what's going on with positioning, and how is the market actually priced relative to all this stuff. So I think if I had to basically kind of pick and choose and say, you can only just take two types of indicators, you're not allowed to use all the other stuff, for me it would be valuations and technicals, because valuations tell you that kind of background, risks and opportunity setup. It helps you prioritize where to look for opportunities. And then the technicals, obviously, like, end of the day, if you're only allowed to look at one thing, you'd be looking at technicals, because, there's a lot of information in price, and ultimately, price is the one thing that doesn't lie. Even when you can say that the price is wrong, i.e. there's an opportunity or a risk there, that's still in a useful piece of information.
I agree with that, yeah. Obviously, don't want to kind of put you on the spot too much, but obviously, what do you think the kind of next 6 to 12 months look like? We seem to be in this kind of Goldilocks scenario where up until, today, stocks were making record highs, gold, the highs. There seems to be a lot of kind of things economically and traditionally that aren't kind of, correlating as they once did. So what are you looking for? What are you looking to shift? I mean, I guess what I'm asking is, what's going to break first?
The main lens that I've been looking at is in terms of the macro risks, or the sort of big kind of scenarios at play here on that standpoint, is basically opposite ends of the spectrum. So deflation risk and recession risk on the one end, and then on the other end, the opposite of that. So growth actually reaccelerates and you get inflation resurgence. And so, I mean, I think probably the deflation risk, recession risks, pretty well understood. The other end of the spectrum would be, okay, well, and probably people are saying, well, how do you get that? Because, things are kind of actually looking a little bit patchy. Well, start off is you just look at on the monetary policy front. Even last year, there was a big wave of monetary easing. And then this year, we actually kind of got a second wave of easing because, back in April, we had that sort of panic moment, and you had all the tariffs and things, and people were like, oh, well, central banks are like, oh, well, this is going to be a headwind to the economy. We better do a bit of easing. And so if you look at the monetary policy leading indicators, like where the amount of stimulus that's gone on, that points to actually pretty significant reacceleration in growth. And then you look at some of the data too, like for the most part, things are actually kind of hanging in there, pretty resilient. And then you throw into that a few extra things, like, some of the tariff influences might start to shift investment into other sectors and regions. And then I think, you sort of also add into that bit of a washing through of the inventory cycle. And you can probably get to a scenario where you say, okay, growth actually picks up. And you look at China, Europe, they've been doing quite a lot of stimulus. And then, of course, US is, they're trying to get that rate cut in, and meanwhile still doing the fiscal, stimulus side of things. So I think there's a reasonable case for it. And then how that flows into inflation side of things, well, inflation expectations are still pretty high. And I think psychologically, that dual inflation shocks 21, 22 still on everyone's mind. So I think it's not going to take much extra inflation for that to kind of ripple through and start really factoring in. Like, I think the moment you see a bit of inflation start to come through, whether you're a landlord or an employee, everyone out there is going to be asking for a little bit more money, trying to get, factoring that into wage negotiations, etc. And then commodities, I've the way I look at commodities, the outlook's pretty bullish. And so, and then you think about labor market capacity still pretty tight, and then maybe some tariff stuff as well. It all adds up to me to say, inflation resurgence. And so how does that tie back into markets? What's sort of overpriced, underpriced relative to that? Gold's probably overpriced, sort of, it's already kind of overdone at this point. Stocks are obviously, especially growthy tech stocks, very expensive. Commodities, ex-gold, cheap. And so like if I see the two biggest assets that are the cheapest at the moment, they're commodities and bonds. And so, okay, if we get growth, reacceleration, resurgence, that's not good for bonds. But it's great for commodities. But then if we kind of take a few steps back again and say, well, actually, if you didn't get that and instead you get recession risk, deflation, because the tariffs kind of make things go under, and all this monetary easing, well, that was actually for a good reason, because things are actually worse than we thought. Then in that situation, bonds benefit. So it's kind of like your macro risk sandwich, and or a sort of barbell of diversifiers on that, or your bonds on the one end and commodities on the other end. And so I think from a practical standpoint, that's actually kind of useful to help frame things as well, because if we see treasuries, bonds starting to do, starting to break out, then that's actually useful information, because it tells us, oh, actually, maybe it's that scenario. Versus if commodities are really starting to break out, then maybe that's the other end of the scenario, where commodities benefit from growth, demand, things of this nature. So in terms of how do we see what's coming? Well, one is we can track some of the data, but then we also keep an eye on those assets that are going to benefit from those two different forks in the road.
So yeah, I understand that as well. So obviously you're always looking at things from a portfolio kind of perspective, so you're never overexposed to anything. I understand that completely. So if you're an individual investor or, even a trader, I mean, how would the kind of your analysis, help them, people that are making shorter term, more directional trades based upon all the things you've said? I mean, it's not everyone has, the funds to be able to balance out a portfolio or even make it worthwhile for them. So a lot of people are just out there individually, hunting stocks, looking for the next 10x or 100x. You mentioned AI, well, I've seen 100 startups over the last couple of years, they're not all going to make it, are they? So, how do we put this into the real world, kind of sphere that your average retail trader can kind of benefit from? You've got any thoughts or advice on that?
I think it kind of helps frame your next move, what you should be thinking about next. So it's pretty clear that the AI stuff, the tech stuff is, very frothy, bubble-like conditions. And so your next move there should be thinking about, what's your plan from a risk management standpoint? What if things all of a sudden drop 20% before you can, gracefully just exit? I think in general, this is probably good advice. It's not spending too much time chasing the next hot thing, but rather than focusing, time on how do we actually identify the next hot thing, focusing on process development, on getting, establishing good sources of information. And so that also involved, because I understand probably it's the most boring or uninteresting advice is these are the areas where we can go to reduce downside risk impact or diversify, so your bonds or your commodities for that other end, and also like defensive equities, things of this nature. From an individual investor standpoint, I think it makes sense to actually be interested in the uninteresting things like that, because if you think about 2022, where we had the market rollover from one of the most frothy, speculative driven markets in recent times. In 2021, just a crazy markets back then. All the signs were there, and then on the diversifier side of things back then, the way I look at things, bonds were expensive back then. And so, they were not actually going to be, in hindsight, they were never going to be, a diversifier, a protector. They were never going to perform that role that you wanted them to perform. And so what was cheap back then was commodities. And then, of course, we did get kind of the perfect storm. But I think being open to these other sources of information and not getting too caught up in the speculative moment, because everybody wants to make a whole bunch of money and get rich. These things go in cycles, and I forget who said it, but the investment opportunities, they're like buses. They come over and over again, and just like the cycles, they're gonna like cycles are seasons, if you want to call it. You got winter's gonna come. You can ignore the boring, unsexy diversifiers and defensive position, but then you're the grasshopper who didn't get prepared for winter, and
you're the one holding the bag.
So I think and I think everybody has to do this themselves. So you've got to find your balance between how much do I want to chase the opportunities, how much do I want to try and get rich, versus how what am I still going to focus on that's boring and uninteresting and defensive, that's going to at least, if things turn slowly and smoothly and I'm able to cash out at the top, that's awesome. But if things turn very quickly, you can't catch it in time, or, psychologically you can't eventually, stick to your risk management process and get out in time, you've still got this kind of safeguard there that goes up when everything else goes down. And, because the last thing you want to is to be sitting there with all these, all your hot internet stocks. They went from $100 down to $20, and you're at the bottom of the market and you were fully invested. You didn't have any dry powder to deploy when things got cheap again. And it's important to note on that, as much as I'm sitting here and saying tech stocks are expensive now, a decade ago they were cheap. And I would have been, if I was looking at the same indicators, strictly back in 2009, I would have been saying, it's cheap, and that's what you should be doing. It's getting into bonds or commodities at the moment is boring and uninteresting, but getting into stocks back in 2009, it wasn't that it was uninteresting; it was like unpalatable. It's the whole, when it comes time to buy, you won't want to, and so it's we're kind of wired to be our own worst enemy, and so having a good data-driven approach is one way to kind of defend against that.
Oh, that's good advice. I mean, that also like drives me onto another kind of, obviously, kind of topical sector, asset of cryptos. So we can't really ignore cryptos anymore, I guess. They're part of the establishment now with the ETFs, etc. Especially Bitcoin. So, I mean, how are you putting in that into your kind of asset allocation and your models? What's your thoughts for Bitcoin for the next 5-10 years? Is it going to replace fiat? Is it going to 100x? Is it going to be $1 million? Is Michael Saylor right? Again, this comes back into the more exciting element of what if, what could be. So what do you think? If you're keeping it on your level, data-driven kind of understanding, what would your kind of thoughts be to crypto traders out?
Yeah. So, I mean, I look at it, but kind of almost more as a source of information. So, because if I look at most of my clients, majority still aren't kind of into that space, nor will ever be. I mean, some institutional investors even look at gold and say that that's, so.
Really?
So that's kind of an interesting side note, but
yeah, absolutely.
So I definitely look at crypto as like a sort of measure of liquidity in the system, speculative risk appetite, and so and you can kind of reconcile that with the way that you explain that is because if you look at Bitcoin, for example, trades very correlated with tech stocks, and for good reason too. So, I mean, in terms of how it fits in, I think, yeah, you're right. At this stage, it's sort of become undeniable. It is part of the establishment now, and I think that there is a case to be made. The investing case is kind of like it's a easier to store version of gold that kind of defends against fiat devaluation, and that's it's almost less relevant for like for people in currency countries where the currency doesn't really move much, but for people in countries where their currency falls by 50% kind of on a routine basis, that's actually a very attractive feature. Like, it's easier to have digital currency than it is a gold bar, for example. So I think that the investment case on that front is there. I think that big picture, it is an investment instrument. It's an instrument for speculation. From a transactional standpoint, like as a business owner, I don't really see any point for it. Maybe that changes in the future if it becomes easier to transact in, more stable, cheaper to transact in. But in terms of how I'd be looking at it at the moment, so I've been steadily building out some of the indicators because I think I should probably, having said all that, I probably should actually start including it as a regular.
Skin in the game, yeah.
So the things that I've been looking at are ETF, the ETF market. So implied allocations there, they've reached record highs. And so, we should expect over time that it will be growing because of the growth of that asset class. But at the moment, it's probably beyond, where sort of normal growth would have taken it. And then I look at some of I've been running a semi-annual survey actually for a good few years now, probably since 2018, I think it was. And that just reached a record high in terms of number of individuals or percentage of individuals that are saying that they're allocating to crypto or Bitcoin. And so I think there's a growing number of direct information that says this thing's starting to get a bit overcooked maybe on this cycle. Because even if you believe that long term, the line goes up, and there's a lot of things where you can say, okay, I know what the trend is going to do. Like stock market, probably going to trend up over time, but we can also know that there's going to be a cycle around that trend. So I'd say that for Bitcoin, that trend's probably up. We're probably at the top of that cycle around the trend at the moment, and especially also because we can get corroborative information from tech stocks, which are overvalued, overhyped, overallocated, overflowed. And so I think collectively, when you look at the information collectively and, sort of bring in the AI side of things as well, it says to me, well, we better be careful with those. I think that the things that are most at risk are your tech stocks, Bitcoin, gold, which gold probably surprises a lot of people, but it's my indicators say it's a very overvalued, overhyped, and yes, it's still technically an uptrend, but the technicals are kind of getting into topping mode there as well. And then it's again all those other things that are kind of been left behind that are looking good. So your bonds, and so on gold versus bonds, it's an interesting one because you can actually look at gold and bonds as kind of equivalent in some respects as a defensive asset. Much in the same way that on the other side of things, you can look at stocks and Bitcoin as, both risk assets. So, you might even say that the new 60-40 is 60 Bitcoin, 40 gold. And it might be that you switch between the traditional and the new one. But if you look at the ratio, the relative price of gold versus bonds, that's looking very stretched as well. And then you look at valuations, they're just in the opposite direction. So I think I would be looking at, just like heading into 2022 when bonds had that sort of generational loss, gold is kind of sitting in that position now. So I'd be looking at gold as a source of risk, bonds as a diversifier of risk on the defensive side of things. And then, I do see a lot of opportunities in stocks ex-US. So if we look around the rest of the world, one that's almost debate whether I should mention it is frontier markets, because there was an ETF on frontier markets, but they delisted it last year. And as you might kind of expect, if you've been following the ETF market, whenever they close something, it's almost always at the worst possible time. So since they closed it, it broke out and is it's actually been outperforming key stocks even. So frontier market equities are on a tear, and they've coming out of they were cheap, not so much now, but they were cheap, and the currencies are cheap, and relative value is still quite significant there as well. But I think even some of the other overlooked areas like Chinese stocks that they kind of march to their own beat a bit more versus global stocks, and that's something that I think is very interesting at the moment, especially given the technicals as of late.
Yeah, I mean, that's interesting, because I speak to a lot of people as well, that kind of travel around the world and do different things. So it's kind of, you look at Argentina, for instance, and Mele, what he's done. So it's kind of, it's just at a different stage in the cycle completely economically. So there will be obviously kind of, risks involved, but, as you say, relatively cheap currency and different opportunities. I think the kind of valuation point that you look at, a lot of US stocks are just out of reach for people. Physically you can trade them, but you can't afford to buy them. They're too expensive. So, people will shift out to different, kind of places to look for that value, which, I know you've put a lot of value on value. So it's, that's what you have to do sometimes, isn't it? Look for those next opportunities. So when you talk about, your research and, how you do it, who are your clients, your target market? Do you have a lot of individuals, or is it institutions? Do you sway it one way or another, or you just, as you say, you just present the data as you feel, or are you mindful of, who accesses it and can actually use that information, if you know what I mean? Who has the ability to use that?
Yeah. So for the institutional service, I write that for institutional audience. I mean, and so that means, number one, writing for their context. So, and I think that's quite important too, like understanding all the issues, challenges, things that they have to deal with. So I think that's useful for them, but also for me to try to frame it to that, which I think can still be quite interesting and beneficial to people who aren't necessarily in that environment, because you're still dealing with things that are going to be relevant. I do have an entry-level version of that, which is I wouldn't call it a retail version. So the reason why I came up with the entry-level version was that people were either like, well, the institutional stuff's too expensive, we don't have budget for it at the moment, or institutional stuff is too much information, just give me the key points. And so it's kind of, matching those two requests into one, and it's actually, I would say about 50-50 in terms of take up of that. So 50% is like, the people that I expected to, financial advisors, fund managers, other investment professionals. Now the ones are basically, high net worth individuals, profession, people that have got a serious portfolio, want that kind of long-term, big picture perspective. And there's a few traders there, but and for the traders, it's kind of more of a, I've kind of already got my process for generating short-term, directional bets, but I want to have a bit of a, what's the kind of background weather report, where are the opportunities, the next set of opportunities going to come from, or where are the risks that are potentially going to derail what I'm working on is going to come from. And then of course there's the chart storm, which that's for everyone. Even then though, I'd say that I don't dumb it down as such, but I can still keep it kind of conversational as well in terms of the tone. Yeah.
Okay, so something for everyone. So I guess my less kind of like thought on this. Obviously, there's a couple of things in my mind. Obviously, you're based in New Zealand where I am, so a lot of, like you say, like old school money. In New Zealand, that's the way it is. Are you seeing a shift in money being passed down, or attitudes to younger generations to getting hold of, the kind of the more direction of their own portfolios? Are looking for different things, or are we pretty much still status quo? This is just my own interest in New Zealand. Is it still pretty much business as usual? They see the future in the same way, or is there any kind of cues or clues that are creeping through that we might see a bit of a shake up in New Zealand?
I honestly have no idea. I mean,
No, fair enough.
Yeah, so my institutional client base are about 30 or 40% Australia, New Zealand, and then the rest is all Europe, UK, US, North America. So yeah, that's the thing. I definitely have some New Zealand clients, but it's mostly a global audience because these days you can reach. But I find New Zealand is actually pretty advantageous spot to be in because you, from a business standpoint, you can talk to clients or prospects. You get Europe at the end of our day and the US at the start of our day. And then from a market standpoint, you don't have to sit through all the noise of the whole trading day. You just get the closing action. And the way I look at things, that's what I prefer to look at. I think, it's kind of old news or one of those old secrets that the best time of the day to be looking at price action is the closing, because it's it's the well, at least back in the day it was the retail would rush in at the start of the day and then be the professionals sort of closing things out at the end of the day.
Yeah, it's not quite as easy when you're a trader, but yeah, from an analysis point of view, absolutely. Yeah. So is there any other points that you want to kind of talk about, or is there anything that you think the kind of the wider audience would benefit from? I guess we're kind of coming towards the end, so we can just throw in anything. It doesn't matter what it is. Anything that you think might want to kind of just bring to the table.
I can't think of anything immediately, but for anyone who wants to sort of follow on with what I'm doing, you don't have to buy any stuff. You can just follow me on Twitter and. I put out sometimes relatively cryptic statements.
But, you do. I love replying to them because, I get it. Yeah.
I mean, I think that most of the time, it's a couple of words around a chart, and most of the time that's because, in my mind, the chart kind of says it all, and the chart kind of should be doing most of the talking.
Exactly right.
But I have learned across the years on that front that even when I think the charts do all the talking and, I've got all the right charts in the right order, in the right combination, you still have to tell a bit of a story around it. You still have to kind of spell it out. So that's part of the journey of growing up as a researcher.
Absolutely, yeah. And the dangers of Twitter, X, I still call it Twitter, I'm old school. The danger is that, people can very easily misinterpret what you say, and they want to be proven right or even prove you wrong. Again, that must be the difficult part from someone, from your perspective, where you're just trying to give an opinion. You're not saying necessarily buy or sell. You just give an opinion based upon the data and what it is. Whereas, people are just looking for that. Well, do I buy or sell it? Come on, just do my job for me.
Exactly. But I think too, even on that, as somebody who's old school finance Twitter from back in, the old school finance Twitter was quite cool back in 2016, sort of before everything got crazy. But anyway, you still had disagreements back then, and I remember having a beer with someone from that I met on Twitter, and we were sort of discussing that you could actually have a dozen different investors all basically taking a winning position. from their standpoint, and each person that they sort of interact with thinks that the other person's an idiot, or they're sort of, but like it kind of just goes to the fact that with different, there's so many different time frames, approaches, context and constraints, etc., that you could actually have a dozen different people with strongly held views, accurate, correct views, and never to be unable to agree with each other because they just sort of misunderstood what the other person's context was. So if you have a long-term state-old asset allocator, they might have a completely different view from a day trader or somebody who's venture capitalist or some hedge fund long short person. There's and so I think that's if you do go on social media and talk markets, you got to understand that, because there's going to be it's okay to agree to disagree, or not have them buy into what you're saying, because they might be operating from a completely different perspective, and at the end of the day, the way markets are made is that we all go in with our own views and with our own levels of conviction, and in the end, we're going to be right and wrong.
Totally agree. Totally agree. Yeah, well, exactly. Yeah, I totally agree with the. I think I started my Twitter in 2013, maybe. So, but anyway, yeah, I think the world in general is a bit more fun. People are a bit less polarized, but then that polarization has kind of filtered through society, I guess, into Twitter finance. But yeah, I think as always, got to give your opinion. You need to stand by your opinion based upon your track record and what you think. And yeah, everyone has the right to disagree, in my opinion, still. And if you don't like it, they'll have to follow us. That's the way I look at it. Well, listen, it's been great, mate. We should definitely try and catch up in New Zealand and continue this chat, because it's been good. A lot to think about for me. A lot to learn. I think some great insights for the viewers. So as you rightly said, people can follow you and get your research from topdowncharts.com, and on X it's Callum_Thomas, and you obviously say you're pretty kind of available on LinkedIn as well. So that's just an easy search. So yeah, it's been great. Really appreciate your time, and well, thank you very much.